Click the bell icon to get latest videos from Ekeeda.
Hello friends, let us do one question asked in university examination where we are required to prepare vertical balance sheet and calculation of certain ratios. Let us read question. Following is the balance sheet of Roland Limited. Equity share capital. This will be part of share capital. Preference share capital. Share capital. 7% debentures. This will be part of borrowed funds. Secured loans. 8% public deposits, part of borrowed funds. Unsecured loan, bank overdraft, current liability. Creditors, current liability. Unpaid dividends, current liability. Outstanding expenses, current liability. Reserves, part of reserves and surplus. Provision for taxation, current liability. Profit and loss account, part of reserves and surplus. Cash in hand, current asset. Cash at bank, current asset. Bills receivable, current asset. Debtors, current asset. Stock, current asset. Advances, current asset. Furniture, fixed asset. Machinery, fixed asset. Land and building, fixed asset. Goodwill, fixed asset. Preliminary expenses, this is fictitious asset. This will be deducted from shareholders fund. Calls in arrears on equity shares, this will be deducted from called up equity share capital. Convert the above balance sheet in vertical form and calculate current ratio, quick ratio, proprietary ratio, capital gearing ratio, stock working capital ratio, and give your comments. Here we'll have first shareholders fund. Here we have first item share capital. Equity share capital 1 lakh. Calls in arrears in equity shares 5,000. Equity capital is rupees 1 lakh. Less calls in arrears on equity shares 5,000. So equity share capital paid up amount will be 95,000. 6% preference share capital 1 lakh. So total share capital 1,95,000. To this we are going to add reserves and surplus. Reserves 1,50,000, Profit and loss account 20,000. Reserves plus profit and loss account 1,70,000. Preliminary expenses 10,000. Preliminary expenses, fictitious assets will be deducted from reserves. Less preliminary expenses 10,000. So it will be 1,60,000. Share capital paid up 1,95,000 plus reserves and surplus 1,60,000. So shareholders fund we got 3,55,000. To this we are going to add borrowed fund. In borrowed fund we have secured loan 7% debentures 40,000. Next, unsecured loan 8% public deposits 20,000. Total borrowed funds 60,000. First part of balance sheet, total capital employed 4,15,000. In application of funds, first we have fixed assets. Furniture 30,000. Machinery 1 lakh. Land and building 2,20,000. Goodwill 30,000. Total fixed assets 3,80,000. Next, long-term investments. In this question, there are no long-term investments. Next, working capital. There we have first current assets. Cash in hand, current asset. Cash at bank, current asset. Bills receivable, current asset. Debtors, current asset. Stock, current asset. Advances, current asset. Total current assets 1,72,000. less current liabilities, bank overdraft current liability, creditors current liability, unpaid dividend current liability, outstanding expenses current liability, provision for taxation current liability. Total current liabilities 1,37,000. Total current assets 1,72,000. From this, current liabilities will be deducted. So we got working capital 35,000. This working capital will be added with the fixed assets to arrive at total assets. Total fixed assets 3,80,000 plus 35,000. Total assets we got 4,15,000. Sources of funds 4,15,000 is tallying with application of funds 4,15,000. We have completed first part of the question, converting the balance sheet in vertical format. Now we are required to calculate these 5 ratios with comments. Computation of ratios, ratio formulas, workings, and finally comments. First we have current ratio. Current assets upon current liabilities. Continue. Current assets 1,72,000. Current liabilities 1,37,000. So current ratio we have 1.26 is to 1. Next we have quick ratio. Quick assets upon quick liabilities. Quick asset means current assets minus stock minus prepaid expenses or advances. Quick liabilities means total current liabilities minus bank overdraft minus income received in advance. Here we have total current asset 1,72,000, of which stock is 40,000, advances 20,000. Total current liabilities 1,37,000. Among this we have bank overdraft 40,000. Quick ratio is 1.15 is to 1. Next we have proprietary ratio. Proprietary ratio is equal to proprietor's fund divided by fixed plus current assets multiplied by 100. Proprietor's fund, shareholders fund, total we have 3,55,000. Total we have 3,55,000. Fixed assets 3,80,000. Current asset 1,72,000. So proprietary ratio we had 64.31%. Capital gearing ratio. Capital gearing ratio. Capital with fixed income, preference share capital plus debentures plus public deposits divided by equity shareholders fund, equity share capital plus reserves and surplus minus fictitious assets. Preference share capital 1 lakh, preference share capital 1 lakh plus debentures 40,000, public deposits 20,000 divided by equity share capital 95,000 plus reserves and surplus 1,60,000. Capital gearing ratio 0.63 is to 1. Formula is closing stock divided by working capital multiplied by 100. Stock 40,000, working capital 35,000. Stock working capital ratio 114.29%. We have calculated all the required ratios. Let us comment on that. First we have current ratio 1.26 is to 1. Standard current ratio is 2.1. Standard current ratio is 2 is to 1. Here company is having current ratio 1.26 is to 1, that is less than the standard. Therefore company have unfavorable company have unfavorable current ratio. It means company's short-term solvency position is not good. Second, we have quick ratio 1.15 is to 1. Standard quick ratio is 1 is to 1. Company have quick ratio better than standard. Therefore, it shows strong liquidity position. Proprietary ratio is 64.31%. Proprietary ratio is more than 60%, showing satisfactory long-term solvency. Capital gearing ratio 0.63:1. This ratio suggests that company is low geared. Stock working capital ratio is 114.29%. Standard stock working capital ratio should be less than 100%. In this case, company is having stock working capital ratio 114.29%, which is higher than 100%. Therefore, it indicates poor stock management by the company. In this question, we have learned how to prepare vertical balance sheet, calculation of various ratios, and brief comments on those ratios. Thanks for watching this video. Stay in tune with Ekeeda and subscribe to our channel Ekeeda. Thank you.